Bismillahirrahmanirrahim. Assalamu alaikum. I'm Dr. Adnan Malik, and we are discussing the first chapter of my book on Takaful. And the title of this chapter is Insurance. And today's our topic for discussion will be the mechanism of insurance, how the insurance mechanism works. It's a $1 million question. Normally, people get surprised that how an insurance company can pay huge claims while taking very small premiums from its clients, like uh, a property worth of millions and a few thousand premium is taken by an insurance company, and if a loss occurs, insurance companies pays millions. For instance, if we take insurance of our car, the worth of the car will be in thousands, while the premium will be in hundreds. So, how insurance company manage to pay huge claims, how it collects money, how it charge a suitable premium from the client. So, today in this session, we'll be answering these questions. We will take a few examples, and with the help of example, we'll try to understand this mechanism. This mechanism has basically three steps. The risk transfer mechanism of insurance. Second is the creation of a common pool, and third one is charging equitable premium proportionate to the risk being transferred by the client to the pool. So, taking start, the mechanism of insurance, we'll try to clarify it through an example. Say a client has a car worth 17,000 US dollars, which if we convert in Pakistani rupees is around 5 million, around, not exact, but around. So if the client wants to take insurance of his car, then in Pakistan the prevailing rates for comprehensive motor insurance are 1.5%. So 1.5% of the vehicle value, and it comes around $250 USD, or the in Pak rupees against the 5 million insurance, the premium will be 75,000 per annum, and the company, the client will pay this premium, and accordingly, the company will receive their premium, and if a claim occurs, then the insurance company will be paying that money. How the claim can occur? It can be theft, it can be a total loss in an accident. So the premium rate, as I mentioned, for a person with very good driving history, like the person has not met an accident, and the use of vehicle is for family purpose, not for commercial. So the premium rate will be around 1.5% of the vehicle value. So annual premium in this case comes to 255 US dollars per annum, and in Pak rupees it will be 75,000. So when the client pays this much premium once in a year for coming 12 months, the vehicle will be covered against the loss of total loss, partial loss, theft, and third party liability. Total loss means if in an accident the vehicle completely gets destroyed and it's not repairable, then the insurance company will be paying 5 million Pak rupees or 17,000 USD. If there is a partial loss, means the vehicle is repairable, then it will be repaired at its cost. And if there is theft, again the insurance company will be paying 5 million Pak rupees or 17,000 USD. Third party means if due to the driver's mistake some other person property is damaged, and the mistake of the driver or the owner is proved, then that third party loss has to be covered by the insurance company. So, how an insurance company pays big money in compensation to its clients after receiving um, um, small premium. So, client pays 255 USD or around Pak rupees 75,000 annually, and if the car is stolen or total loss in an accident, then the company will pay 17,000 USD or Pak rupees 5 million to its clients. So, how this 1.5% rate is decided, how the insurance company takes the risk of 5 million just against the premium of 75,000 Pak rupees or 255 US dollars. So we'll try to explain this mechanism. So insurance company collects small amount of premium from many clients and pays claim to few who experiences a loss. Insurance company has statistics that how much losses can be reported if it covers a particular number of clients, say vehicles. And the insurance company also knows from the past experience that what will be the average claim size or amount. So this large compensation becomes possible due to the following mechanism and functions of insurance. Insurance company takes the risk of financial loss of a client based on this mechanism, which I'll be explaining. The mechanism has three steps: providing a risk transfer mechanism, creating a common pool where all the money of the client gets pooled, and setting equitable premium. Equitable premium is a premium which is in proportion to the severity of the financial risk which the client transfers to the insurance company. So, first step, providing a risk transfer mechanism. Insurance is basically a risk transfer mechanism in which the client transfer the risk of financial loss to the insurance company. Like in the above example, 17,000 USD was the maximum financial loss which a client could face due to theft or total loss of the vehicle. And client thought that there should be an entity who, if this loss occurs, could compensate the company. So it transfers that 17,000 USD risk of financial loss, and insurance company agree to accept that risk of financial loss, but ask the client to pay the price for this coverage, which happened to be 1.5% of the vehicle value. So, the primary function of insurance is to transfer risk of financial loss from insured to the insurance company against a premium, as I mentioned. Here we can further understand this process through case study 1.3. It's basically displayed in my book. Uh, Transferring risk. Caroline owns a car worth 60,000 USD. The car is one of Caroline's most valuable possessions. If it is stolen or damaged, Caroline understands that it will cost her a handsome amount of her hard-earned money. So, to manage these and other risks associated to her car, Caroline buys car insurance. Buying insurance means transferring the risk of financial loss to the insurance company and pays premium, that is price of insurance, at the rate of 1.5% of vehicle worth, that is 900 USD. If the car gets stolen or gets completely destroyed in an accident, insurance company will pay 60,000 USD. Through buying insurance, she transferred risk of financial loss of 60,000 USD of her car to the insurance company. So that's the first step in this whole process. So, where insurance company keeps that money which it receives from the client, it creates a common pool. It's pool of money, like we have a swimming pool where water is collected. Here, the money is collected in a common pool which comes from different clients. So, insurance company pools all the received premium in a common fund. It invested for earning return on it, and claims are paid from this pool fund. Claims basically the amount which an insurance company pays to the client if the defined loss occurs. Like if we see the defined loss in vehicle or car insurance was accident, total loss or partial loss, theft or third party liability. So, in managing a common pool, the insurer benefits from the law of large numbers. It tries to cover more and more clients so that its statistics becomes accurate according to this law. The higher the number of similar situations covered, like more clients covered, the more the actual number of events occurring will tend towards the expected number of events. So insurance companies normally use statistics and calculus to predict the loss pattern. So based on this knowledge, the insurer can decide a premium, and the client knows, depending on the type of cover purchase, that they will not have to pay anything more at the end of the year. So Caroline knows that it only has to pay 900 USD in an year in a year, and if within 12 months if any loss occurs, insurance company would be compensating her. So then there is a setting equitable premium. Equitable premium means that insurance company should be charging the price of insurance in relation to the risk of financial loss being transferred by the client to the insurance company. So higher the risk, higher the premium. So if somebody is using his vehicle as a for renting purpose, then it will be more on the road, more chances of accidents and theft. So the premium will be high as compared to the person who only uses his car for personal use, going to office, taking family for some outing. So the insurer has to make sure that it charges a fair or equitable premium that reflects the risk and value a person or company brings to the pool. So this is a complex process to reach to such an equitable premium, and therefore the insurer has to calculate the premium very carefully. In companies offering life and health insurance, actuaries calculate the premium. An actuary is a person who is trained and experienced in calculating insurance premiums and pension benefits. Actuary can be called the mathematician of insurance and pension benefits. The expert makes these calculations based on the probability of future incidences, developing, creating policies to reduce the probability of undesirable events and their impacts. So, although the premium charge should be enough to cover the claims made, it should also be competitive because there are always multiple insurers in the market. If the premium is too high, the insurer will lose business. On the other hand, if the premium is too low, the contributions to the pool have the possibility that they would come to less than the cost of paying claims, which would result in a loss for the company. So the company should be charging sufficient premium but not very high to remain competitive so that it has money in the pool fund to pay German claims. So the three functions of insurance makes it possible that insurance company accept the risk of financial loss of the client and promise to pay the client if a defined loss occurs. So these three functions of insurance are thus interdependent, as creating a common pool and calculating your equitable premiums all helps to provide a sound risk transfer mechanism. So these three steps makes it possible that insurance company accept the client risk and agree to provide them the insurance coverage for their property, for their life. So this is how the insurance mechanism works. I hope this video made it quite clear how the insurance mechanism works. So stay tuned and please make comments on the video. If you have questions, please raise it so that I answer it accordingly. Thank you so much and take care.